Okay, can you hear me all right with this? Okay, so it's a bit of a shame everyone's not here today, because today, this week and next week are the most important weeks, because your final exam, 50% of that exam is on cash flows, right? And there's nothing like being in the classroom to be able to ask what you need to ask. So definitely hearing it here and then hearing it within the tutorial are definitely important. So yes, 50% of your final exam includes doing a cash flow. There's a handout just up here. I'm going to grab it. Okay, so we do it in two parts because there's quite a lot to get through, but really we're looking at Chapter 6. Now, in terms of preparing a cash flow, this is where accountants, if you can get good at it, this is where you can be very, very productive in the organisation where you work. If you are able to effectively prepare, analyse and review a good cash, in terms of cash management, because cash management is the number one reason that businesses fail, because they don't monitor where's your money coming from, what are you spending it from, can you do it better, can you do it differently, and in particular, in combination with the cash flow, is your overall cash management strategies and looking at cash budgets and all that kind of stuff. All right? So what this is where we're going to look at AASB 107, where we specifically look at the preparation of a cash flow. When you do a cash budget, essentially what you are doing is you are mimicking your cash flow at that other level, all right, at a budget level, and showing your money coming in and out. And then your actuals, right, is essentially what you come up with here. But we do it in a summarised version here. In business, you need to do it in a much more micro way. So this is a macro view. When we look at the cash flow when you're in business, you need to do it at a more of a micro level, right? But if you can do this well and understand how to prepare a good cash flow, I promise you, it's the number one reason why me, for example, in my circumstances, why I was the boss and in charge of 25 people at the age of about 24. Right, so I was in charge. I was the manager of financial services for a very big organisation. They employed over 2,500 people, and that's like now I think they've got like over 5,000 people working for them. So it's going back a few years now. But the number one reason was because when you understand how to do this, and then you can understand how to pull it apart and fix it when there's a problem, I promise you that that's how your bosses will notice. All right, so with this we will hopefully highlight that profit is not the same as cash. All right, and that preparing a cash flow statement is quite different to doing your P&L. We'll look at the benefits and the limitations. So as with any macro type report that we prepare here, so remember these reports are primarily for your annual report, right? And they are done in the preparation of your core financial statements at the end of financial year. So it does have limitations in that it is at that macro level. You need it to be able to use it and utilise it at a micro level. So we need to look at the different types of inflows and outflows. So where's your money coming from? What are you spending it on? And we're going to look at one primary way. So there are a number of different ways that you can prepare a cash flow. We're going to focus on one primary way. We will look at the other way. So hopefully you realise that profit is not cash. Can anybody tell me straight away what is the obvious reason why your profit figure is not ever going to be the same as your cash when you are preparing financial statements? Well, yeah, not just receivables and payables, but all your accruals, right? So all your accruals, your depreciation, any of your balance day adjustments that you're doing, because remember when you're preparing your profit and loss, what you are doing is you're trying to get an indication of what is the revenue that you've earned for the period, and you've matched it against the expenses incurred in earning that revenue. All right, so sometimes you've got revenue where you may not have received the cash yet, and the obvious is your accounts receivable. And depending on the timing and the cycle of your business, sometimes those can be quite high. But remember what I've always said, when you're in business, you're not a bank, right? You are not in the business of giving people credit. Right, so you need to really manage your accounts receivable and ensure that where you have it, that you have it for good business reasons. All right, and when you start to get bigger and you're dealing with bigger customers and clients, things like that, you know, then standard 30 days is usually okay. All right, but some you might want to look at and maybe only give them 7 days, no credit, they pay cash up front, or 7 days, 10 days, 14 days. But when you start looking at the larger businesses, it's normal practice to negotiate 30-day terms. All right, so it is normal practice. But if you're a small business, remember I've said this a lot as well, a lot of students coming out will be working, about 80% of students will work in small businesses. All right, so you really want to have a look at that, because that's where people can become, you know, you think you're doing the right thing and you end up, you know, people abscond and do the wrong thing, right? There's not that many people out there that do the wrong thing, but, you know, unfortunately, you don't want to be one of the ones that gets hit and ends up on the news. Like when I was a bit younger, there was a guy that went to a hardware store, and this is the thing, and he did it around country areas, so he did it in Collie, Bunbury, Harvey, you know, all country sort of areas, at Mitre 10 stores actually it was. So there's not that many of them around at the moment. I think a lot of them now are home hardware and that. But he went into them, set up accounts, bought all this stuff, and over a 2-week period he absconded with about $70,000 or something. He got caught, all right, because, you know, Australia's a small place, unless you're going to, you know, jump on a plane and disappear. But yeah, so he posed as a tradie with a business, and they gave him credit, and he did it at quite a few stores. I think he did it in Collie, Bunbury, Harvey, Margaret River, and maybe even Albany as well. Right, so I think there was 5 different places he went to, and yeah, got nearly, I think it was nearly $70,000 worth of goods that he essentially stole. And that's just a little thing, right? You don't think it's that much, but you know, when you're a small business, you lose 10 grand, that could be one person's job. You have to sack someone because you've lost all that money. Now you can't afford to pay their wages, because there's no way that you're going to be able to make that up quick enough. Okay, so why do we look at a cash flow? It's there to supplement your profit and loss and assessing your company's performance overall. Specifically, we're looking at liquidity and solvency issues, and it does allude to problems. If you're doing them on a regular basis, and you're looking at where's your money coming from, what are you spending it on, what bills have you got coming up, it does highlight your liquidity and solvency. And if you want to be successful, you have to manage your cash. So also looking at investing, so specifically looking at when you've got extra money, being able to use that money and make more money, or when you haven't got enough money, being able to get loans and being able to service that debt into the future. Right, so also looking at companies and paying dividends and retiring and paying down debt. Okay, there's lots of different questions. These are just a sample of questions, obviously, looking at the business's ability to generate positive cash flows. So one piece of advice, if you're going to buy a business, don't bother looking at too much of anything else. Look at the bank account, right? If they won't give you the bank statements, it's very difficult to manipulate and to basically what would you say, make up transactions and money going in and out of a bank account. It's very difficult to do that for a long period of time. You could do it for a couple of months, but it's very difficult to sustain it. If someone's selling their business, you want to look at a couple of years of bank statements and have a look, where's their money coming from? What are they spending it on? And looking at that, and particularly focusing on where is their money coming from. So what are their sales? How are they? What are they doing in their business? And looking at the seasonal variations and that. So if you can't get at least 2 years worth of bank statements, just walk away. Don't even bother. Don't even bother buying the business, because it's quite common practice. Now, it doesn't sound good, but it's very common practice where businesses will have a few sets of books. They will have the real set of books, the set of books for the tax man, and then the set of books for the person they might sell the business to. All right, so just be aware of that. If you're ever looking at buying into a business, or perhaps giving a client advice on buying into a business, you know, that's for me, that would be the very first thing that I would look at. Right. The second thing is, what assets have they got? Are their assets new? Are they old? What is the ability of that company to be, you know, how can they use those assets? How are they using them to make money? Right, so when you're buying something solid, you know, you've got something. If things go wrong, you've got something to sell to try to make back a bit of money. But if you're buying something which doesn't have necessarily any physical substance, you know, looking at goodwill and all that kind of stuff, and looking at those intangibles, that's a whole different kettle of fish then. You know, particularly when you're looking at the tech industry, it becomes, because then it's the people that are important, right? Because it's the knowledge in a lot of those tech companies where the money is. So you're effectively buying the people rather than buying the product, because technology is changing, and it's changing very quickly all the time. All right, so with AASB 107, there are some very specific things that it requires, but it's also open. So it does allow you to make choices, but once you've made those choices, you need to be consistent. So gross cash inflows and outflows, they must be classified by activity type. They must be reconciled, so you must look at your cash and cash equivalents at beginning, and they must be reconciled to your cash and cash equivalents at end, so you must show the movements. And your cash from operations must be reconciled to your operating profit, so we'll show you that. So the 3 different types of activities that you need to classify your cash into is operating, investing and financing. Right, reasonably straightforward. Let's go through what they mean. So in your handout there, figure 6.1 there on page 1. So those of you who haven't got the handout yet, it's just down the front here. Come and grab it if you haven't got it. So there's a handout. So I just did this just so that you've got that in front of you in case you couldn't read up here properly and you'll need it maybe to make notes. All right, this is a reasonable example, and remember in the final exam you will have to prepare a cash flow. You don't have to rely on your memory. Something like that you could cut and paste, shrink it onto your page of notes, all right, and stick it in the corner so that you don't have to rely on your memory for the different types of items that could go in there. All right, so that gives you an indication of where we need to get to. Right, so we know that we're going to have a heading of operating activities, investing and financing. We have to total each of them up, and we have to choose which items go in those items. So that's where we'll look at our key definitions. At the bottom, you'll see that we have a net increase or decrease, and then we have got an opening balance and then a closing balance. That closing balance here, that must equal your cash and cash equivalents in your balance sheet at the end of the financial year. All right. Okay, so first we have to define what are our cash and cash equivalents. We need to classify them. That means we have to decide what the activity is. Is it operating, investing or financing? Then we have to decide the format. There are 2 acceptable formats for under AASB 107. All right. One of them that you will see on page 2 under figure 6.6. That's one acceptable format. It's just like that. The second acceptable format is where essentially the first section, the cash flow from operating activities, is replaced with a reconciliation of your operating revenue to your operating profit in your P&L, right? And then the other two sections stay the same. This is essentially what I want you to do, and that's what you'll be doing for the exam, all right? But if you do this way, you have to do a note, which does that reconciliation because the standard requires you to reconcile. So when you've prepared your profit and loss, so that's your revenue minus your expenses to give you your profit, you have to reconcile that profit figure to your operating in your cash flow. So if you've got a profit figure of 100,000, right, you need to reconcile the movements there in your operating to your operating activities. All right, and we'll show you how to do that. Essentially what you do is you remove all the non-cash items out of it. So you just take out your depreciation, you take out your accruals and things like that. So there's lots of different ways to do it. The way that I'm going to teach you how to do it is very structured, very step by step. All right, so and being able to do it manually, and it's a good thing to learn how to do it manually like this, because when there's problems and the errors in business, what it does is it gives you the tools that you need to go back and go, okay, let's have a look here. This does not working, let's look here. Let's look here. Because sometimes when you automate everything, because most businesses have automated cash flows now, but guess what? Sometimes they don't work because people do manual journals, or there's errors with your transactions for your accounts receivable or accounts payable, or someone's put some of your accruals to the wrong accounts. All right, so it's usually human error. But what it does, being able to do this manually, it means that you know exactly where to go and look, and you can quickly reconcile line by line by line where something might be a little bit out of whack. Okay, so step 4, we do our cash flow, which is that item there on page 2 of your handout, and the second bit, any additional notes, right, that we might have to prepare. So what is our cash and cash equivalents? Right, your cash is your items that are very easily converted to cash. So remember, sometimes you might have a bank overdraft. So it means your cash figure could be negative. All right, so if you have a bank overdraft, that's very common in business for some businesses to run very high bank overdrafts because of the timing of the revenue that they earn. The timing of their revenue may not necessarily reconcile with the end of a financial year, for example. And you've got to pay your bills, you've got to pay your staff and things like that. So one of the companies I worked for, we actually ran with a $5 million overdraft, right? And what that was, and they allowed us to do that because we had cash reserves elsewhere, right? So they knew that we had the money, but maybe it was tied up in longer term investments. But they knew that by, within a week, that money would be back in there, all right, because of the flow of the money, that it was a government organisation, and they got regular money coming in all the time, all right, with different government grants and government funding and all that kind of stuff, right? So it's not uncommon to run a bank overdraft, okay, but if you don't have to, don't. Obviously, because sometimes it costs you money, sometimes it doesn't. Sometimes banks are generous and they'll let you run an overdraft at no cost because you're a good customer, but other times it will cost you. And if you don't meet the criteria, the fees that you might end up incurring could be quite high even if you miss it by a minute. All right. So we need to work out what is our cash and cash equivalent. So we'll do a few different examples in the tutorials with a couple of different items where we'll add a few other things in there, not just your cash at bank. There could be some other short-term securities in there as well. And it needs to be clearly distinguishable from other investments. Other investments that are more than 3 months are not considered to be cash and cash equivalents. All right. So interest as well. So interest is paid, is considered to be a operating activity, but the standard does allow differences. All right, so our operating activities are our obvious, hopefully it's obvious to you, it is your normal principal revenue producing activities. All right, so whatever your core business is, all right, where's your money coming from, what are your expenses? So includes everything about your core activities, whether you're paying rent, wages, for supplies, all sorts of stuff. All right, includes inventory and everything, all your core activities. Where your investing activities are more specifically to do with your non-current assets and your longer-term assets and plant and equipment and buying and selling those kind of non-current assets. All right. Obviously, if you're in the business of buying and selling a lot of assets, that's your operating activity, isn't it? So it's got to be looked at in the right context. So whatever your core operating activities goes into your operating. Your core non-current assets, which assist you in making that money, all right, are your financing activities. So your core long-term and non-current assets. Your financing activities is all about where do you get your money from to run your business. Have you issued shares? Do you have a bank loan? All right, so it's all about your financing arrangements. So if you have issued some more shares, then that would go into your financing activity. If you have got a $100,000 loan from a bank, that's a financing activity. Okay, the interest attached to those activities, for if you had a loan, the interest attached to those borrowings, right? The standard allows you to make a choice as to whether you include it in operating or financing. All right. So this is how the textbook approaches it. Interest received is treated as investing because your interest, let's say you've got $100,000 in a 12-month fixed deposit, the interest from that is considered to be investing. Right? Interest paid, because you've had to go and loan money to run your business as part of your normal operating activities, it gets treated as operating. All right? However, if you want to, you can treat it differently. All right? The choice that you make as to whether you include it as investing or operating, you must be consistent. All right? This, however, is what you would say business does most of the time. Like 99% of the time, you'll find they do it the way that the book teaches. But the standard allows you to do it differently. Dividends received. So dividends received means obviously that you've got shares in another company, doesn't it? So it's an investment, right? That's treated as an investing activity. Your dividends paid is treated as a financing activity because where did you get your original money to run your business? You issued shares. Those share issues are a financing activity, right? Therefore, the dividends associated with them are a financing activity. Okay. So when we start looking at the individual operating activities, you can reference your little handout there on page 1 and write any notes if you want to write any extra little notes to jog your memory as we're going through. They are the principal revenue, so some examples of inflow, so it's money coming in, the sale of goods or the rendering of services, royalties, fees, commissions, interest received. Notice I've got there in brackets, it could be investing. All right. Dividends received, it could also be investing. All right. Your outflows, on the other hand, are your payments to your suppliers and employees for goods and services, government income taxes and lenders for interest, but remember that could also be financing as well. And if we have a look at our cash flows from our operating activities in the handout in front of you, notice how we separate it into our cash receipts from customers. We've got cash paid to suppliers and employees. We've got that cash paid to your suppliers and employees, there's a couple of calculations there. All right, because your suppliers, if you've got inventory and that, you've got to review a number of accounts to determine what's the cash component for that. And then your employees, it's your payment for salaries and wages, long service leave, annual leave, anything to do with employee entitlements as well. Then we've got interest paid and income taxes paid. All right, we must show them separately. All right, so your interest paid and your income taxes paid must be shown separately. That is a requirement of AASB 107. All right, then we total it all up and we've got our net cash provided by operating activities. The other thing we have to be concerned about under our operating activities is GST. So here in Australia, we currently pay a 10% GST. Amounts that appear should be net of GST. However, things can arise and problems can arise when we have bad debt write-offs. We have discounts allowed and discounts received. So where there are changes and movements in that area of your accounts receivable and accounts payable, we need to make sure that we account for the GST component of that as well. All right, so that needs to be taken into consideration. All right, the net amount of the GST payable, so when you pay that to the taxman as part of your taxes, that is treated as an operating activity. All right, so it's your payment of your GST to the taxman. Okay, now just elaborating a little bit more on your investing activities. Remember, it's anything to do with your non-current assets. Right, so we've got some inflows, so look at that side first. We've got sale of non-current assets, could be property, plant, equipment, intangibles, shares and investments. Repayments of loans advanced to other parties, so when people have paid us back. And again, notice how I've got their interest received and dividends received. They could be either investing or operating. Your outflows, so your money going out, your acquisition of non-current assets, whether they be property, plant and equipment, intangibles, shares, investments, and if we lend money to other parties as well. All right, and from a corporation's point of view, sometimes they might lend money to employees, they could lend money to subsidiaries. All right, so it's not uncommon for a large corporation to lend money to a subsidiary because it's cheaper to do that than to get a bank loan, get the financing from elsewhere. So keep it inside your financing activities. So just before we do the financing, notice though that with your investing activities on your handout there, you've got your purchase of investments, purchase of property, plant. Notice how they got brackets around them. That purchase is a negative, means the money's gone out. Proceeds from sale of equipment, so you've sold the equipment and received some money, it's a positive amount. Interest received and dividends received, positive amounts. Okay, now we've got our financing activities. So remember, this is how do we get our money to start our business in the first place and to get more money to run our business. Did we issue shares? Have we got a bank loan? So we could have got an inflow from issuing shares or other equity instruments, also issuing debentures or having other borrowings. We could have outflows where we bought back some shares, we have redeemed shares, we have repaid debentures or other borrowings, and we've paid dividends. When we pay dividends, we could also treat it as operating. Okay, but let me go back to that little summary we did before. This is how we are going to do it in this unit. We are going to treat interest received as investing, interest paid as operating, dividends received as investing, and dividends paid as financing. All right, that's how we're going to do it. We're going to keep it consistent all the way through. Okay, the statement of cash flows does exclude non-cash investing and financing activities. So you might wonder, well, what kind of non-cash activities are they? Potentially quite a lot, especially where assets get exchanged, right? So acquiring another business by issuing shares as well. There's no cash involved, you just issue the shares. Conversion of liabilities to equity, right? Acquiring equipment by entering into a lease. All right, so the ongoing lease payments, obviously there's a cash component. So remember, anything that hits your bank account is going to be appearing in your cash flow at some point because you have to reconcile it. All right. Acquiring investments or property in exchange for other investments or property. All right, there are potentially lots of other non-cash items that come up. What do you do with them? If they are material, they must be disclosed in a note. That note can appear on the face of the statement if it's important enough, down at the bottom as a note, or alternatively as a note in the additional notes later in the financial statements. Right? But if it's really important, right, and it's very, materially significant, so I would say anything, probably above 10% of the value of the, the revenue turnover of the company, I'd say that would be significant to put it on the face. Everything else, if it's over probably, you know, 10, 20, 30,000, depending on the nature of the business. It might need to appear in a note. Transactions that do not affect cash are not reported in the body of the statement. So here we go. But they could be in a note. Okay, there are a number of ways of preparing a statement of cash flow. The way that most businesses do it is essentially when you're doing your bank rec, remember this is not a bank rec, this is a statement of cash flows. But when you are doing your bank reconciliation, most financial management information systems facilitate your ability to code all the items coming in. So anything that relates to accounts receivable and invoices and invoice numbers that get reconciled as part of your bank rec, they will automatically be grouped together as part of your cash receipts from customers. So if you have a look at your handout there, you've got cash receipts from customers, right? So when you run a report, you can pick up all those items that are coded to be that through your bank rec. When you've reconciled it and you made sure that those things are all coded correctly, that can pick it up. So that cash book approach, you'll find that that's how most businesses actually do their bank rec. But like I said, it doesn't always work. When you're dealing with a financial management information system, when you're dealing with manual journals, right, and people doing adjustments for discounts, bad debt write-offs and things like that, then it can create issues. All right, so you need to make sure that you've got good systems and processes in place where the reports that you do factor all those things in there as well. So, but if you're working in a reasonably simple organisation, which a lot of people are, it's very, very easy to actually set up your cash flow straight from your bank account. All right. The reconstruction of accounts approach is what we're going to do. All right, this is what you'll be required to do in the exam. And there are a few shortcuts, and there's a couple of ways that we can do it differently. With that reconstruction of accounts approach, you have to remember how to do a T account. You have to remember your accounting formula. All right, so you've got your assets minus your liabilities equals your equity. And remember, your equity includes your profit, which is your revenue minus your expenses. All right, to increase those accounts, for your assets, you're going to debit. For your liabilities, you're going to credit. Equity, you're going to credit. Revenue, you're going to credit. Expenses, you're going to debit. All right. When you're reconstructing your T account, because essentially what we do is you have your profit and loss, you have your balance sheet. We essentially have to reconstruct nearly every balance sheet account. Right, so we have an opening balance and a closing balance. If it's an asset, the opening balance will be on the debit side. Right. If it's a liability, the opening balance will be on the credit side. So we have to work out what's our opening and closing balance and what are our movements in between. Are there any transactions from our P&L that we can pop in there? Therefore, the amount of cash must be the missing amount. So that's what we have to do with our reconstruction of accounts approach. And this is how most businesses will actually do it. And so this is the way I used to do it. Obviously, financial systems have become more sophisticated, but I used to have databases set up and spreadsheets and that all set up where it imported all the data in that I need to put in. I made sure that all the accounts were reconstructed, what the movements were, and I could quite easily pick up where the errors were. So it all fed through to a statement of cash flows. All right, but you have to be able to figure your way through all the debits and credits when it doesn't work. All right, you've got to realise that you have to essentially go through your balance sheet. So on page 2 there, you've got a statement of financial position. You've got to be able to go through your balance sheet, look at the movement in those balance sheet items, match it to your profit and loss, which you've got there on page 1, for all the expenses that you've accounted for, and then to basically reconcile it back to your cash at bank. All right, so your cash at bank here, I think this is out of whack actually. It's just, it's 21,050 for 2020, and 2019 it was 25,000. So for 2020 we're reconciling it. Put a circle around that 21,050 when we go through the example in a minute. That's what we're reconciling to. All right. So that reconstruction. The other approach is your statement of financial position approach, which we do a little bit. We kind of merge the reconstruction of accounts and the statement of financial position approach with the balance sheet, and we do a little bit on the formulas, but I prefer, you'll understand when we get into it, I prefer to actually do the T accounts. I'm a visual learner, and when I see a T account, I see an opening balance, I see a closing balance, I see adjustments from the P&L for payments for expenses, etc. that goes in. There's your cash. All right, so that's what I prefer. If you want to use the formulas, I'll show you the formulas as you're going through. And if you're good with that, you know, and you're fine with it, it's definitely quicker. But because most people are quite visual, actually no, that's not really true. It's about 50-50 really. Everyone's a little bit different with their learning style. But I find the way that I'm going to teach you is probably the best way to do it. All right, rather than learning the formulas, because if you get the formula wrong, because they change, it's not just one set formula, the formula can change depending on some of the items and whether you're adding it or minusing it. All right, and in an exam, when you're a little bit stressed, you can plus something instead of minusing it and it stuffs it up. Whereas if you do the formula and you know your opening and closing balance, because that's really all you have to remember, and make sure you get it on the right side, you're pretty right, and it'll show up really quickly if something doesn't work out. Right? Because if it doesn't reconcile and you're out by $1,000, you can quickly look for that $1,000, or look for double it, look for 2,000, or look for half of it, look for 500, and you can have a quick look through it, and you can find it very quickly. Okay, so with the cash book approach, just a quick example here. So straight out of the textbook, where you've got 12 different items. It's just a case of going down those items and deciding what items are operating, what are investing, and what are financing. All right, so cash received from your trade debtors, obviously it's part of your normal operations, it's operating. Your cash paid to your creditors, it's operating. Interest received on investments, remember we're treating that as a financing item. Okay. Your wages and salaries, normal business, operating. Insurance paid, normal business, operating. Other expenses, normal business, operating. Cash dividends paid, we're going to treat that as a financing activity. Okay. Now did I say investments? Did I say financing or investing? I see it, there should be investing. It's in the word, I should have known, I should have listened to myself. Whenever you see the word investing, it's usually investing. All right? So, sorry, my brain just had to catch up with the fact that I made a boo-boo. Dividends paid is a financing. Your equipment purchased is an investing. Your proceeds from the sale of equipment, it's a non-current asset, it's investing. Investments purchased, it's investing. And then you've got your opening and closing balances. So if we go through that cash book example, items 1, 2, 4, 5 and 6 are operating. Your investing items are 3, 8, 9 and 10. Your financing activity there, item 7, and then you've got your opening and closing. So all we do is we group it all together, and then we end up with our cash flow, which is 6.6. All right? So that's just, we've done it that way. That's just a quick cash book approach. All right? So you end up with the same. We're going to get the same result with the next one, but we're going to look at it in more detail when we look at the reconstruction of accounts approach. All right? So notice here our cash and cash equivalents at the end of the period, 21,050. That reconciles to your balance sheet. If you look up on that page, you can see that your cash at bank at 2020 was 21,050. All right, so that's what we have to balance to. Your 2019 balance of 25,000 is included in there as well. So you've got a net loss, obviously. Then we have an opening balance of 25, meaning your closing balance is going to be a little bit less. All right. Okay, so let's do our reconstruction of accounts approach. Okay, so first we need to record the opening and closing balances of the account. Right, so remember here where we've got our T account, when we set up our T accounts, we have to decide what side it goes on. If we muck this bit up, you muck up the whole process. So if it's an asset account, you've got an opening balance on the debit side, all right, and then a closing balance on the credit side. Step 2, include the entries in the account that relate to non-cash transaction and events for the period. Number 3, determine any missing items, work out the cash. All right, so if we have a look, so reference this in front of you, so you're on page 2, have a look at your statement of cash flows. So the item there, your cash receipts from customers, that $471,000. In order to get to that, we have to reconstruct our accounts receivable account. But remember, associated with that is your allowance for doubtful debts and any bad debts, right? And any discounts allowed. All right? So we'll keep it simple to begin with because they're not all in there, but they're in examples that we're going to do later. All right? So your cash paid to your suppliers, we have to reconstruct your accounts payable and your inventory account. So we've got an asset account there in your inventory, and we've got an accounts payable, which is a liability account. So figures from your inventory account are going to be transferred over to your accounts payable. So we'll show you that in a minute. Your cash paid to employees, remember that's about salaries and wages. So we have to reconstruct our provision for employee benefits. So if you have a look at your statement of financial position, your balance sheet, have a look under your liability, provision for employee benefits. Right, so what that is, if you haven't heard of that before, is where you've set aside money for things like long service leave, annual leave and sick leave. All right, because people are entitled to those things. So in Australia, we have rules and laws. So when you're a full-time employee, your usual minimum entitlement is 4 weeks annual leave. All right, most businesses will have a long service leave entitlement after 10 years. Some are more generous and will give it after 5 or 7. All right, depending on the nature of the organisation. Remember, this is a obligation. Then also sick leave. If you're a full-time employee, you're generally the minimum requirement is you're allowed 20 days sick leave. All right, per annum. Most sick leave is accumulating as well. All right, sometimes it's not. Some businesses will only let you have 20 days in a year, and that's it. And if you don't use them, you lose them. Right? Other businesses will allow you to accumulate that sick leave over a number of years. Right? My father, for example, never had a sick day in his life, but when he did get sick, if he wanted to, he could have taken nearly 3 years off. It was ridiculous because he's never had any sick leave and he worked there for a really long time. All right? Cash paid for other expenses. So what you need to look at is you need to have a look at other accrual type accounts. And if you have a look in your balance sheet there, we do have an other expenses payable with an opening balance there of 3,000 and a closing there of 2. Right, so we have to reconstruct that. Income taxes paid. We have a look at our tax account. Do we have a tax account in there? If we did, we would need to have a look at our provision for current taxes and deferred taxes. We have to reconstruct them. I'll show you how you can group them all together in one. When you group accounts together, you put all the opening balances where they need to go and all the closing balances where they need to go. And then you can have a look at the actual amount of income tax paid from the P&L. Interest paid, we need to reconstruct our accrued interest and interest payable account. So that's an example, and essentially what we will do eventually is we'll go through each one of those balance sheet accounts and make a decision whether it needs to be reconciled or not. Is there a cash component in there? Is there a movement? Is there a matching in our P&L that needs to be part of that reconstruction as well? Okay. So there are shortcut formulas for your cash receipts from customers. So we start off with your sales revenue, so that you get that from your profit and loss. You add your accounts receivable at the beginning, minus your accounts receivable at the end. All right, or essentially what it is your sales revenue minus your increase in accounts receivable. Or sales revenue, add a decrease in your accounts receivable. This is where, in an exam situation, you could get confused whether you plus it or minus, depending on whether it's an increase or decrease. So when you look at your balance sheet and you have a look at your movement between the current year and the previous year, you might forget whether you have to plus or minus it. All right, so even if you have it written down on your little summary sheet that you're allowed to take into the exam, sometimes you can muck it up. All right, so that's the first one, little shortcut. Your cash payments to suppliers, employees and other. You start off with your cost of sales. Right, you minus out your inventory at beginning, add your inventory at end, add your accounts payable at beginning, minus your accounts payable at the end, which essentially gives you your cost of sales, minus your decrease in inventories, minus an increase in accounts payable. Or cost of sales, add an increase in inventory, add a decrease in accounts payable. All right. Your cash paid to employees. You start off with your employee expenses from your P&L. So notice with each of them, we're always starting with a profit and loss figure. So we started with the sales, then we started with the cost of sales, now we're starting with employee expenses. All right, add your provision for your employee benefits at beginning, minus your provision at end, which is essentially your employee expenses minus an increase in the provision. Or you start with employee expenses, add a decrease in the provision. Cash paid for other expenses, so this is where you've got other expenses, so there could be quite a lot of them. Add any payables attached to those other expenses, minus, so add your opening balance, minus your closing balance, essentially is your other expenses, add a decrease in that payable, or other expenses minus the increase in the payable. Okay. So it's a lot to take in, and that's why you have to go step by step by step. All right, and essentially tick off each item in your balance sheet as you're going through. All right, so you won't learn it all in a day, so it's one of those things that requires practice, but you know you have to practice it because it's in the exam. All right, so again, just to reiterate, let's have a look at that 6.9. In order to work out our cash flows, to work out our cash receipts from customers, we're going to recreate our accounts receivable, T account. Cash paid to suppliers, we're going to recreate our inventory and our accounts payable. Cash paid to employees, we're going to recreate our provision for employee benefits, T account. Cash paid for other operating expenses, we're going to look at our other accrual accounts such as prepayments and expenses payable. Right? From investing activities, we have to look at our equipment account. So you go to your balance sheet, have a look at your non-current assets. Are there any movements? Have you bought any? Have you sold any? All right, so we recreate those T accounts and use any other additional information if we need to. Proceeds, have we received money? So we've sold some equipment. How much do we get for it? $5,000. Obviously, we're going to have $5,000 in our cash flow, money coming in. Purchase of investments, we have to recreate our investment account. Interest received, we need to make sure that we recreate our interest receivable, right, to work out the cash component. All right, so just because we've got interest owing to us doesn't mean we've got the cash. We have to work out what is the cash component. Now, our financing, dividends paid, we have to recreate our retained earnings account because remember, dividends get paid out of our retained earnings. The other thing with dividends is quite often businesses will have two lots of dividends. You have an interim dividend and you have a final dividend. The timing of those dividends and what period they occur in can vary as well. So quite often you have the final dividend from the previous year being paid in the current year and the interim dividend from the current year. The final dividend from the current year normally gets paid in the next year. All right, so you have to make sure that you get them in the right period as well. All right, so essentially what we're going to do is we're going to start with our balance sheet and we look at our profit and loss. We're going to recreate those accounts. All right, so if we have a look at our movement in our accounts receivable account, all right, our opening balance, so remember our account, so it's an asset, so we're going to have an opening balance on the debit side and a closing balance on the credit side. Okay, so if we have a look at our accounts receivable, go to your balance sheet there on page 2, you can see your opening balance there is 43,000. All right, your closing balance is 52,000. What have you sold during the year? You have sold $480,000 in your sales. And therefore, the amount of cash received must have been 471. Right, so that's a simple version. Remember, not taking into consideration discounts or other adjustments or sales returns or anything like that. Okay, so keep it simple. Then we make it a little bit, as we keep going along, so next week and in the tutorials, we just make it, gets a little bit harder. All right? So your shortcut formula, if you didn't want to do the T account, but remember, if you're a visual learner, when you see that T account, straight away you can see the amount of cash. With the formula, you've got your sales revenue, add your beginning accounts receivable, minus your ending accounts receivable, same result there of 471. All right. Your payments to your suppliers. So your suppliers are supplying you inventory, so we need to recreate that inventory account first. So let's go and look at that. Okay, your inventory account. Inventory is an asset. So have a look at your balance sheet. Your opening balance there of your inventory is 52,000. Your closing balance there is 50,000. If you have a look at your profit and loss, back over the page, you have a look at your cost of sales. So your cost of sales there is 336,000. All right, so make sure you just reference it on here so you know exactly where it's coming from. We've got opening and closing balances from your balance sheet, from your inventory account. Your cost of sales comes straight from your profit and loss, 336,000. Your current accounts payable for the current year, the difference in there. So when we add up those accounts, the highest side is 386. It's a T account. It must balance at the highest amount. The difference there is 334. That 334 needs to go into your accounts payable account. Now your accounts payable is a liability account. Notice how the opening balance has now changed sides. All right, the opening balance is on the credit side. So if you have a look at your balance sheet, you can see your accounts payable opening balance there of 32. Your closing balance is 38. We've transferred over the 334 from our inventory. We've totalled it up. All right, the bigger side is 366. This has to be the same. Therefore, the amount of cash we paid must have been 328,000. Okay. If we want to, if you have a look at your cash flow statement, that 328,000 is part of the 409. All right, so you might actually want to write on there next to it that 409 is 328 plus, because we're going to add some others for employees and other onto that. Okay, so that's your shortcut formula with your suppliers. So you're going to start with your cost of sales, minus out your opening inventory, add your ending inventory, add your beginning accounts payable, minus your ending accounts payable, all right, which is essentially cost of sales minus your decrease in inventory minus an increase in accounts payable gives you 328,000. So now we're going to have a look at our employees. So remember that in your statement of cash flows, it's cash paid not just to suppliers, it's employees and other. So now we're doing the employees side of it. We've got an opening and closing balance. So if we have a look at our provision for employee benefits, we've got an opening balance there of 4,000 and a closing balance there of 6,000. It's a liability. Opening balance is on the credit side, all right? So we have an opening balance on the credit, closing balance on the debit side. We've got employee expenses of 65,000, turn back over to your profit or loss. You can see we've got employee expenses there of 65,000 on your handout. All right, add up the biggest column, the biggest side, which is your credit side, adds up to 69,000. Your T account must balance to 69,000. Therefore, 69 minus the 6 gives you 63. The amount of cash you've paid to your employees must have been 63,000. Shortcut formula, employee expenses, add your beginning provision minus your ending provision, which is the same as your increase in your provision. So we've got 65,000 minus the 2,000 gives you 63. All right, some businesses, remember, could have multiple provisions. They could have a provision for annual leave, provision for long service leave, and provisions for other employee entitlements as well. So you might need to group them all together, or depending on how they are divided within their balance sheet and with the profit or loss. That 63,000 needs to get added. So before, where I said you've got 409,000, part of that is the 328, add in the 63 there. Okay, let's have a look at our other type expenses. So if we have a look at our balance sheet, we have a prepaid insurance account. So prepaid insurance is an asset account. The opening balance is on the debit side of your T account. Opening balance there of 5, closing balance there of 3. Your insurance expense of 8,000. If you have a look at your profit and loss, you've got insurance there of 8,000. Add up your T account, which is the biggest side, is your credit side at 11,000. Make sure that your T account balances 11 minus the 5 means the amount of cash you paid must be 6,000. Right, that 6,000 gets added. 328 plus the 63, add the 6. All right, other expenses. All right, we have got other expenses payable. That is a liability. So your opening balance is 3,000. Notice that's on the credit side. Closing balance is 2,000 on the debit side. Other expenses from your profit and loss are 11,000. Right, pop that into there. Add up our column. T account needs to balance. It balances at the higher amount on the credit side of 14,000. 14,000 minus the 2 gives you 12. All right, so the amount of cash that you paid in other expenses must have been 12. That 12,000 gets added to the other money, the 328, the 63, the 6 and the 12. All right. So that makes up your 409. So we've got cash receipts from customers, 471, which was easy, just a recreation of your accounts receivable. Cash paid to your suppliers, employees and other. A little bit more complicated because you have multiple accounts. So you've got multiple accounts in your balance sheet to recreate and to match to items in your profit or loss. All right, so that's 409 made up of the 328, add the 63, add the 6, add the 12. So your net cash from your operating activities there is 62. Right, that's 62,000 when we've done the operating activities. If we use the other method of preparing our statement of cash flow, so remember I said before, this is the one that we're going to use, and we're going to do a separate note, but another form of a cash flow is where you replace that first section with a reconciliation of that 62. All right, we're going to do that later. We'll do that next week. All right, we're going to treat it separate and we're going to put it in a note because that's how probably about 95% of people do it. They will do it this way and then they'll have the note which reconciles it to the P&L. There are some which put that reconciliation as a part of their cash flow. All right, but I think this way is neater. Right, from a presentation point of view, and that's why most people do it. Okay, so we've done the first part of the cash flow, haven't we? We haven't done it all. We've done the hard bit. We've done the operating activities. We've done the fiddly bit. So don't forget the rest. So we've still got our investing and our financing activities. So the next step is to go to our balance sheet, have a look at our non-current assets. What have we got? Are there any movements in there? So we've got plant and equipment in there, right? So what I've done for the plant and equipment, I've netted it off. Right, which means it excludes depreciation. Right, but you can do it all right, at a cost. So for this example, I've netted it off. All right, we've got an opening balance there. It's an asset. Opening balance is on the debit side of 135, closing balance there of 150. So what we know immediately is that there is a movement in there. We need to determine how much of that movement relates to sale of equipment, purchase of new equipment, and any depreciation expense. All right, so in the question itself, it tells us, so the additional information, so if you have a look on page 1, it says the loss on the sale of equipment relates to an item which originally cost $20,000 and had a carrying amount of $5,000 when sold. All right, so if we have a look at our income statement, we've got a loss on the sale of equipment there of $2,000. So what we need to do is we need to recreate the amount of cash related to that. So we're going to use it at the carrying amount. We're going to take that carrying amount out of $5,000. All right, so we're going to pop that on the credit side. So that's what it's in there at. It's in there at $5,000. We have got depreciation and expense, which is related to that property, plant and equipment from the P&L. You can see there's $20,000, so we have to account for that. So if we add up the carrying amount of the equipment that we sold that we have to take out, the depreciation of 20 and the ending balance of 150 gives us 175. Means there's a 40,000 variation. Must be we've bought some more equipment. All right, so there's 40,000 cash purchases of equipment. So that's going to be an outflow. So if you have a look at your P&L, we can see that we've got an outflow there of purchase of equipment in brackets of 40,000. All right, because it doesn't always tell you straight away, but it's pretty obvious when you reconstruct the account. If there's been a movement, you must have, if it's gone up, you must have bought some new equipment. You've accounted for everything, you've accounted for what you've sold, you've accounted for the depreciation, which is a non-cash component. All right, because we're using the net amount. All right, so in class we might do an example where we do it at cost. All right, your sale of plant and equipment, we need to work out if we've made a loss. So if the carrying amount was 5,000 and we made a loss of only 2,000, it means we must have got some money, hey? All right, so logically in your mind you've ever go, okay, well, it was still in our books at $5,000. We made a loss of 2, but we must have got $3,000 for it. Right? If they got nothing for it, they would have got a loss of 5,000. All right, but they've only got a loss of 2. So the carrying amount, remember your carrying amount is the original cost minus your accumulated depreciation to give you your carrying amount. So that's what it was sitting in the books at, $5,000. So if we've made a loss of 2, therefore we know that we've got a cash component there of 3. Let's validate it. Let's recreate a sale of plant and equipment account. We don't have any opening and closing balances there, obviously, but the original plant cost was 20,000. The accumulated depreciation must have been 15 if the carrying amount was 5. Your loss on sale there is 2, and your proceeds on sale must have been 3. All right, when we reconcile it back to the original value of that plant. Okay, your investments account. If you have a look at your balance sheet, your investment account had an opening balance there of 10 and a closing of 20. So we must have new investments. So there's a purchase there of 10,000. So notice in your cash flow, you've got investments, but it's a negative figure. All right, because it's 10,000 purchase. All right, the interest receivable. So we need to have a look at it's an asset account. We've got an opening and closing balance there. So your opening of 150, closing of 100, your interest revenue from your profit and loss of 1,000 there. Add the 1,000 to the 1,000, to the 150 to give you 1,150. We need to balance it off. Therefore, the amount of cash interest received must have been 1,050. Okay, nearly done. Your retained earnings, so we have to reconstruct our retained earnings to have a look at payments of dividends. Right, we've got an opening and closing balance. Retained earnings is an equity account. Opening balance will be on the credit side. Closing balance will be on the debit. Your P&L summary, which is your total profit for the year, because remember we close off our profit to our retained earnings. So that means that we've got a credit balance there of $70,150. Our T account needs to balance. So it means that there is a $20,000 difference. Must have been dividends paid. All right. Unless the question tells you otherwise, where you might have transferred money out to another provision account or something. We're not told anything like that, and we know that dividends get paid out of retained earnings, so it must be dividends. All right, and remember there are two sorts of dividends. There are interim dividends and final dividends. Okay, does it all reconcile? Yes, it does. All right, so going through each one of the components, putting it under the right heading, operating, investing and financing, add them all up, we end up with a net outflow there of $3,950. All right, that comes off your $25,000 cash opening balance. Does it reconcile to our balance sheet of 21,050? Yes, it does. Okay, so remember some of the additional issues there when determining your cash received from customers. There could be adjustments for bad debts and discounts allowed, cash paid to suppliers. There could be adjustments for discounts received, cash purchases of non-current assets. You might have to account for valuation adjustments or impairment. All right, so you treat them in a similar way to your depreciation. Right, and make sure where it's a non-cash item, we need to make sure that we exclude that. Dividends include interim or final dividends. Final dividends usually get paid in the following period, right, because of the timing. Because normally you can't declare a final dividend until after you have prepared, because you can't pay dividends unless you're making profit. All right, so normally it's usually the final dividend gets paid in the next financial year. Income tax paid can get a little bit tricky when we're looking at your current taxes and your deferred taxes. All right, so you did a bit of deferred taxes in 5013. We'll do a review of that when we look at your consolidations, but I will highlight what they are when we're doing our cash flow statements, because remember there are deferred tax assets and deferred tax liabilities, because what we pay to the taxman, all right, can vary depending on, you know, what adjustments and that we're allowed to make from a taxation point of view. All right, so there are potentially 3 accounts that need to be sort of grouped together in one, where you've got your current tax, you've got deferred tax assets, deferred tax liabilities, that need to be reviewed to determine what is the amount of income tax paid, all right, in terms of recreating them. So that's quite a lot, all right. So we've been going for about an hour and 10 minutes, and that's probably enough, all right. You need to absorb all of that, and next week for homework, try and have a go at the cash flow statements. Do a lot of get the little simple exercises and that out of the way, and make sure that you know how to do it, because next week we're going to look at the indirect method, and we're going to do a lengthier example in the class, right? But what we do next week and then what we do in the tutorial. So this week's tutorial is not cash flow, obviously, it's a review of your corporate disclosure, because we've had a few weeks, so we've had, because there's corporate disclosure in the final exam as well. All right, so this week in the workshop we'll be going through a review of stuff that we didn't get to do last time because we had 0. All right, so that's what we're doing this week. So next week is when we start doing the cash flow. So next week and then the week after, and there's a lot. All right, so what I want you to do is do your best to do as much of your homework as you can. It doesn't matter if you get it wrong, all right, just try it, because if you've got it wrong and then we go through it in class, when we do the new examples, it's better to make the mistakes in class, because you remember it. You remember it when you get to the exam, all right, because your exam, remember 50% of your final exam is cash flow. right? You'll have to prepare one of these. It's going to be a bit more complicated than what we just looked at. That's a very, very simple one, right? So it's going to be a little bit more complicated, and then there's the next step. So we've done the first bit where we've prepared the basic cash flow with operating, investing, financing, reconciled it back to our bank account. Next is we have to do our note, where we reconcile our operating activities, all right, back to our profit. All right, so that's the next bit we'll do, and it starts to get a little bit more complicated. All right, so there's quite a lot to learn. The more that you practice, the better off you are. But I could have spent another 15 minutes or so maybe doing another example, but I think this is enough. All right, because your brains can only take so much. All right, that's a good enough start. So it gives you the groundwork that you need to do the basic ones, because I promise you, when we get into class, I'm going to give you another one a little bit harder, and then again a little bit harder, a little bit harder. All right, it doesn't get any easier. And if you don't understand the simple, you need to know now that you don't understand it, so that you can actually spend the time that you need to spend on it, and you need to come and see me. All right, get your money's worth. All right, so either come make an appointment, come and see me so you know how to do it, or email me. All right, so I'm pretty good with emails, so getting back to people when you ask. All right, so I will see you. There's a few other notes on the end of this if you want to read that in your own time. All right, so there's a few other notes, and this is the indirect method that we're going to look at next week. So that gets quite comprehensive, that note, where we're looking at the movements in those balance sheet items. And it does give you a few tips on GST. Now, essentially, in the exam, I don't focus on GST. All right, I don't do a lot of GST. I figure there's enough without it. All right, so I don't get too, bogged down in the GST. But just so you know, out in the real world, it's a problem. So there's a few little notes there about your GST. And if you can get the gist of everything and you know whether your money's coming in or out, where the adjustments relate to, it's pretty easy to reconcile. All right. So, but they were extra, and there's extra little notes there. And if those of you get the opportunity and you want to know more, you can certainly come and ask about that as well. Okay, so that's it for today. I'll see you in the workshop for those of you that are coming. Any other questions for me? No? Okay. I will see you in the workshop.